All right.
We never made the
Welcome
best
everyone. Thanks for everyone for joining today's national market update. Today we've got Philip Almeida presenting a bit of our updated research and data. We'll also be running through a few updates today on our portfolio strategies, portfolio management, and a few innovations in our research department as well. So yeah, really looking forward to today's presentation, and I'll hand over to Philip. If anyone does have any questions, feel free to add them in the chat, and we'll probably do questions at the very end. And Philip, yeah, if you'd like to take over from here, thank you.
Thanks very much, Paul. So as Paul touched on, we thought we'd change the presentation around a little bit and just take you through in terms of what our clients are experiencing in terms of their portfolios currently. So quick general disclaimer, if you do want to get in touch with us, obviously just catch up with your advisor that's running your portfolio, and we're happy to kind of sit down and talk about your individual circumstances. So quick one, I thought I'd just recap in terms of the performance portfolio strategy in terms of when we're catching up with a client in terms of what we try and achieve and what we try and advise them to do over not just a 2 to 3 year period, but over a 20 or 30 year period. And you can see we probably line these out over a 30-year period where we're focusing on the growth part of their portfolios initially. And then as we kind of move along in terms of their portfolio strategy, we then revert and start looking at kind of income producing assets. So there's different types of assets that generally sit in the portfolio for them. And some of them hold, some of them require, and every year we do catch up with our individual clients and tell what they should or shouldn't be doing, which will ultimately help them build out their retirement, generate a really good, consistent income stream for them. Now, in terms of the investment horizon that I touched on before, you can see in the first, say, 10 years of their portfolio strategy, you know, they've got 2 or 3 options. Usually they're looking to reduce debt on their family home. The second step is obviously upgrading the principal family home. They start building out a family. After that, once they've done their upgrade, they then look at paying off the principal home. So they've got their 10, 20 year home that they're looking to pay off. And then we move into that wealth creation strategy in terms of building out a really good quality, consistent portfolio that's generating income for them with a mixture of growth and income. And then as we convert that portfolio 15, 20 years into their portfolio strategy, we're looking to build their retirement portfolio. So we probably have more of an income focus on that part of the strategy. So I think it's really important, and giving you a little bit of a visual here, you can see that there's assets that sit in the portfolio that are trading type assets. So these are assets generally that may be traded in the next, say, 3 or 9 years. We have foundation assets that sit in the portfolio that we really don't want that client selling down. So these are AAA rated blue chip residential assets that we want to sit in their portfolio over the long term. So you can see in the first 10 years, there's a mixture of syndicated funds, there's a mixture of trading assets, there's a mixture of foundation assets sitting in there. And then from our end, you know, there are assets that we trade and sell down to pay off the debt on the remaining assets. And you can see in years 13, 14, 15, there's a number of kind of syndicated funds that kind of sit in the client's portfolio to help them pay down debt on their family homes and help them pay down debt on their foundation assets for them to hold long term. So you can see in the first 10 years, it's very heavily weighted towards growth, but there is still a little bit of income sitting in there towards the very end. In terms of case studies, I think, you know, over the last 11 years, we've modeled out, we've got a number of different case studies and clients that we've met with different types of income levels and different situations. But, you know, the goal for us is to have their principal place of residence paid off. And, you know, ideally we want to create, you know, equity within their portfolio of $2.5 million or more. And then we want to set up an income stream for retirement. So I think all of our advisors, you know, and our team have been trained in terms of how to build these portfolios. And it's not just residential assets and finding growth corridors across Australia. some of these assets are sitting in the portfolio to be held long-term. So I might kind of run through a bit of an example today in terms of what a kind of model portfolio looks like. So, our clients that are starting out, they're either, usually we've got a debt reducer portfolio. So we might touch on that today, but generally their household income sits at around 200K. They've got net assets in their portfolio across super, shares, maybe some inheritance of around 400 grand. And then we've got a 5 to 7 year horizon to help build that out. Then you move into the $2.5 million kind of model portfolio where the household income generally sits at around about 300 grand. They've got net assets of around 1.5 mil. We've got an investment horizon of around about 20 years to kind of build that out. But that particular client needs to contribute 25 grand a year to be able to run that portfolio. And then we move into the 5 mil, 10 mil, and 20 mil. So our clients on $1 million a year generally have, net assets of 6.5 mil, and then we can build them out a 20 mil plus portfolio. But generally, when we're starting off with a client, a young client, usually probably around that, say, debt reducer, they're all starting that debt reducer, and we slowly grow it over time. So I think it's really important that you kind of start off at the smaller end, and over time you slowly build that out over time, and you can see the capital contribution that you need to kind of build out each of those portfolios. Now, in terms of the debt reducer, just to give you a bit of a visual here, you can see that it's pretty straightforward. So from our end, our goal for our clients looking to kind of pay down debt on the kind of family home, all it is just going out and buying 3 really good quality assets over the next, say, 10 years. So in the first, say, 3 to 7 years, they go out and buy 3 assets that are worth between 5 and 700 grand. We retain, we hold them, so we don't have to do anything. So we buy one in the first 12 months, 3, 4 years later, we might buy the second, and in years 5 to 7, we might look at the third. And then probably, once we see a reasonable amount of growth in them, we sell all 3 down. We don't do it all in the 1 year. We obviously want to reduce their capital gains tax. But I think from our end is we look at the sell down, we pay down the debt on their family home, and then they've got no debt on the family home. And then we can start looking at maybe a 2.5 or a 5 mil portfolio. So that hopefully that gives you a bit of a visual in terms of, how many assets you need to sit in that portfolio. And it comes down to how much debt they've got on the family home, or how much debt they're looking to, reduce. But generally, the majority of our clients have, got debt of anywhere between 500 and 1.5 mil that they need to pay down. And they can probably look to achieve that by looking at going out and buying kind of 3 assets at that sort of value range. Now, this is obviously an example of one that we've actually built out. So this was a client that came to us back in 2014. Young doctor, it would be great if we could continue to buy these little terraces. We bought them a little terrace in Newtown in Sydney. We bought that particular terrace for around 650,000. We then probably there in 6-9 months, then bought another property in Wooloowin up in Brisbane. And then we probably looked at an investment here in Melbourne in Flemington. So, their income was sitting at around about that 350K. The compounding annual growth on that portfolio is 8.22% just on growth. And then we generated some income uplift. So, the overall return was just sitting above 12%. But it does take time for that asset and that kind of debt reducer strategy to grow. So you do need to give it time. Subsequently, they've sold down those particular properties and now bought their principal place of residence. And they're now looking to build a larger portfolio with us. So it does take time, but if you buy well and you've got the data behind it to buy in those growth corridors, I think you can do really well without overspending and kind of starting off at that $1 million range, because there are options at the lower end. Now, I think I'd probably like to touch on some of the investment methodology in terms of what our advantage is in terms of our reach, as a business that we've set up. Now, in terms of the basics, when we're looking at some of these foundation assets that we want to sit in a client's portfolio, we want that foundation asset for them to hold that property for more than 7 years. So if it's a long-term asset, that we want them to hold, that becomes a foundation asset. Now, if it's a trading asset, we want that particular client to hold it for between 3 and 9 years. The end goal is to be sold, for that trading asset to be sold down to reduce debt on the family home. Usually these are high growth assets, and the timing and the data and getting the data right is really, really important. These are investment grade assets, and usually we're buying those particular assets between 5 and 800 grand in some of the regionals, but there are some opportunities in the capital cities as well. The foundation assets, we want you holding until retirement. There's a mixture of income and growth assets that sit in the portfolio. These are A grade, blue chip. They're in high quality locations, and we want the clients holding them long term. When we're looking at income, we're looking at higher income. These are generally across our syndicated funds, direct commercial property. Usually the annual compounding growth rate of those is 4%, and we're getting a slightly higher yield. For growth assets, when we're looking at growth assets, we're trying to achieve a 7% long-term compounding growth rate, and then around about a 3% yield. So you've got growth and income-based assets need to sit in a client's portfolio at all times, and you need to have a blended approach as well. So we're not just residential focused, and you can see the growth of the commercial department and the funds management department growing, because you need those sorts of assets sitting in a client's portfolio to really kind of help them get to retirement. Now, in terms of our property research, we're probably trying to be very innovative in terms of where we see, we've come up with this new quadrant and kind of mapping software to kind of give us an idea in terms of, where a particular area or suburb in Australia sits. And you can see that we've kind of color coded this as, red generally looks at kind of the stagnation period. The green is probably in that buy or value stage. Blue's probably we're looking to hold assets, or they're in that buy momentum stage. So it's a little bit different. And high demand and short runway, that yellow coding is we're looking at holding assets or possibly even considering selling some of those assets. So this is a runway that we've been able to develop with our kind of research team over the last, the research team have been working on this for the last 12 months. And just to give you a bit of an example in terms of where Geelong sat when we started looking at Geelong, you can see that Geelong's kind of moved into that kind of blue quadrant, which is in that high demand, long runway. And it's now probably moved into probably more of that stagnation period. So from our end, if we can provide that live mapping software for our private clients and give them a really good, realistic view in terms of where the markets are going and where they're tracking, I think this is a really fantastic tool to look at and just give you an idea of where your properties are sitting in that portfolio, long term and short term. You can see that Perth is at the kind of opposite trajectory to what Geelong's doing at the moment. So we're not buying a lot of properties in Geelong at the moment. It's moving into that stagnation period. Whereas Perth, as I touched on before, it's in that high demand, long runway. They're in that buy momentum stage now. So, from our end, Perth is looking, very, very strong at the moment. So this is the kind of live demand runway for houses. And you can see, I'm not quite sure if you can see that, but you can see in terms of the potential for growth and where these particular suburbs are sitting in that 50 to 100%. So even though kind of Bendigo and Ballarat are probably flatten a little bit, you can see that there's a lot more uplift for potential growth within those markets. And if you look at the upper end of the quadrant, areas like Townsville, areas like Gladstone are looking quite good. Not that we're buying too much stock in Gladstone, but Townsville's definitely an area where it's got a population of just over 190,000 people. And look at Greater Perth, look at Mandurah, look at Bunbury, Rockhampton, Rockingham, Wodonga. All of these areas in terms of our runway are looking quite good. But if we look at Geelong, you can see Geelong in terms of the potential uplift for growth within that market is quite limited. So really in terms of where we want our clients positioned, we want them in this little section here where we can see a lot more potential for that runway for growth for our clients. And you can see Central Coast, is at the bottom end of this, Newcastle, Wollongong and Greater Sydney. So Realistically, Brisbane's probably sitting in that kind of, in line with Bendigo and Ballarat. There's a lot more uplift. Adelaide's a little bit further back. Toowoomba's still got a little bit more growth, and Melbourne, in comparison to areas like Sydney, is probably representing a lot more value currently at the moment if we look at our runway for houses. If we go over to units, you can see that Townsville again and Gladstone are probably representing really good value. You can see that Melbourne's kind of moving along, Greater Sydney, Canberra's probably getting to a position where it's starting to soften, Adelaide as well. But you can see Brisbane's a little bit further ahead. There's value in the unit market. Rockingham, there's value in the unit market. Greater Perth, we're actually seeing a lot of value in the unit and villa townhouse market at the moment. So that's definitely an area that's probably been of interest to us over the last 6 or 12 months. The units and the townhouse sector in Perth are probably representing very good value at the moment. Generally, they're probably sitting anywhere between that 5 to 800 grand mark. But they are starting to show value for the first time in some time. So from our end, we're probably taking a position on those sorts of assets at the moment. If you want to take on significant risk, Gladstone again, in both areas for houses and units do show value, but the population in Gladstone is only sitting at around about 30,000 in that catchment. So there is an extreme element of risk, and we probably prefer to kind of concentrate on areas that are probably showing a bit more value with a higher population. So this is the property clock in terms of, and you can see how it relates to our runway in terms of, the green, the buy value, the buy momentum, the hold, the stagnation. And you can really see in terms of where Sydney's positioned, versus Perth, Rockhampton, Darwin, Bendigo and Ballarat. So Bendigo and Ballarat, Ballarat in particular is probably flatlined over the last, say, 6 or 12 months. So we're not recommending clients sell any of their particular assets now because, as you can see with that runway, there is potential for some further uplift. It just kind of has flatlined over the last 6 or 12 months. Brisbane, we've got a hold rating at the moment, and we may pull Melbourne back a little bit further, along with Adelaide, probably closer to Brisbane over the next 6 or 12 months. But you can see in terms of value for the unit market, it's completely different to the housing market. You can see that, probably areas around Melbourne are in that kind of buy momentum phase. Units in Sydney are in that buy momentum phase. Bendigo, Ballarat, even kind of Adelaide are in that hold rating phase. So they're very, very different. And this live runway is just I think in terms of innovating where we see the markets from a live tracking point of view is really important for our business to make sure that we're not exposing our clients in the wrong markets. In terms of national, just giving you a little bit of a national update, Adelaide's really moving along really well. We've seen a lot of strong owner-occupier activity. They're pushing us out as investors. They've got another 10, 15% above what we can afford to pay. So we'd love to be buying in Adelaide a lot more, but we are finding it really tough at the moment. Brisbane is really moving along quite well, kind of stagnated last year, and we've really started to see it starting to move again. There is just in terms of availability of stock, we've probably found it a lot more challenging to buy. In terms of price point, to buy a really good quality AAA rated foundation asset sitting in your portfolio, generally we're spending between, say, 1 and 1.5 to buy a really good quality blue chip house up there. Canberra at the moment, we've probably seen some house price movement there. We've probably seen a little bit of stagnation starting to kick in on the ground. So we're not buying too much in Canberra at the moment as a business. And you can see that probably, again, the Perth market, there's a lot more uplift left in that market. Darwin as well. Greater Hobart is beginning to kind of stagnate and going through that stagnation period as well. So from our end, Adelaide's still been the number one performer since obviously May 2022 up until now. But Perth, Brisbane definitely, Melbourne definitely for those foundation assets, if you want to sit one of those particular assets in your portfolio. And Perth is an excellent trading type play, both in the unit sector and the housing sector at the moment. Capital city vacancy rates. We actually have seen some softening in some of the regional areas at the moment. So we are starting to see rents starting to not stagnate, but we're not getting the same rental increases probably what we were 12 months ago in, say, Geelong, Ballarat and Bendigo. So they have kind of flattened slightly. We are probably seeing increased rents in Melbourne, Sydney, Brisbane, Adelaide and Perth. So they're still moving along really, really well. And you can see the vacancy rates are sub 2% in all of those sectors at the moment. So still really, really low. And we probably haven't started seeing rents soften in the capital cities just yet. Dwelling approvals, you can see that we're still undersupplied by 160,000 dwellings. So if you look at the housing sector, we're undersupplied by about 102,000 dwellings, and in the unit sector, we're not building enough stock. So cost of construction's become a lot more difficult, and we are seeing a lot of an exodus of developers moving out of Melbourne and Sydney and building a lot of stuff up in Queensland and the Gold Coast. We are seeing a lot of activity there. So that will probably move a lot of the unit sector into an undersupply still. So we're not seeing, that particular sector slow down, but there's not a lot of construction occurring in Melbourne and Sydney at the moment because it's just too expensive to build. So from our end, we're still short on accommodation nationally, and we're not seeing that slowing down. Population movement, everyone's talking about overseas migration, but you can see that's a really heavy number. And we're not keeping up with that demand in terms of the amount of inflow coming in because developers and builders can't actually generate the same margins they were generating 5 or 6 years ago. So that's going to put further pressure on rental accommodation, nationally. And, we probably see rents, obviously combine that with the land tax implications in Melbourne, we're probably going to see rents rise quite aggressively in Melbourne for the next, say, 12 or 24 months. Perth, I touched on Perth. We touched on Perth on the last research meeting, but you can see the affordability index is tracking up just slightly. We're still under 40%. It has the ability to get to 55 to 57%. So that you can see that there's a lot more uplift for growth within that residential market. The price to income ratio has risen slightly, but it's still cheaper to buy a Perth house than it is to buy a Melbourne house currently. So it's still running at 6.2 times income. And if you look at units, the price to income ratio is 4.3 times. So that shows that the housing sector and the unit sector currently in Perth is really good value. You can see there's a nice healthy gap between the median house price for Perth, between units and houses, but you can see that there's been a little bit of an uptick there for unit growth and house price growth. Perth versus unit, there's a nice gap there, but from our end, we're seeing both of those particular sectors going a little bit of a run now. So that's not going to slow down this year. So we expect fairly reasonable growth over the next 12 to 24 months for our clients that are already positioned in Perth. Household lending, you can see that, there was a little bit of a dip in household lending for owner occupiers, and it's really shot straight back up. So you can see that the investor lending is probably starting to go on a little bit of a run, but owner occupier lending, for the first time in a long time, there are owner occupiers on the ground going out and buying their homes. So that's a really good sign that there appears to be a bit of confidence on the ground with owner occupiers going out buying their homes, and you combine that with investor activity as well, lending. The Perth market's looking in fairly reasonable shape for the next 2 or 3 years. Stock on market, this is a big one, and a lot of our advisory team and local buying team on the ground in Perth have found it really, really difficult to buy really good quality property because we are competing with owner occupiers. So this time last year, there were kind of 15,000 dwellings on the market for sale. This time this year, there's only 14,000 dwellings on the market. So you can see that average days on market, stock is trading less than, say, 10 days now. It's taking for an average house to sell. So as soon as an agent or a property goes on the market, it's probably sold within 10 days. So that's a sign that the market is quite strong, and there simply isn't enough stock to cater for the incoming demand, which is a really, really strong metric for us to see that we probably expect fairly good growth within the unit sector and the housing sector over there at the ground. And you can see average stock levels have averaged at around about 22 to 25,000, and we're sitting at 14,000. There simply isn't enough stock to cater for that incoming demand. Vacancy rate, you can see vacancy rates pretty attractive. It's under 1%, where, you know, seeing rents have increased from $744 for a house, you know, they've now increased to $791. And for units, you know, rents have gone from $567 for an average unit up to $600 a week. So they are increasing in the unit sector for the first time. But look at this, from 2014 all the way to kind of 2020, there was no growth in the rental unit market for units. And you can see house price rents have increased from $485 back in 2020, and over the last 4 years, they've gone from $485 all the way up to $791. So that's pretty attractive from that end. Job vacancies. So, you know, there's obviously the unemployment rate sub 5%, so it's still pretty attractive. There's plenty of available work, both in the private and public sector at the moment. And you can see mining starting to, you know, it doesn't make up for 40% of the entire workforce. It's down to kind of 24, 25, 26% of the entire workforce now. Now, I think I touched on a new area that we've just taken a position on, Townsville. So the team flew up there kind of 6 months, and we've been looking at this market really heavily on the ground, and we've just started our kind of buying on the ground. I think in terms of your entry point, you know, if you do want to buy a really good quality asset, our recommendation is that you probably need to be around that, say, 480 to 650 mark to buy really good quality housing. The affordability index is quite attractive. We've seen evidence of some price growth starting to hit the market at the moment. But again, price to income ratio is obviously very attractive to us. It's running at 4.8 times income. And then for units, it's running at 3.2 times income. So that's a really good metric to say that it actually is probably cheaper to buy a house than rent on the grounds at the moment. So provided you're around that 5 to 600K point mark, I think it's a very attractive market to be looking at. Median house price, we've seen it going a little bit of a run for both units and houses at the moment. So again, I'd probably prefer that if you're looking at Townsville to buy something really good quality, and, you know, that really good quality price range sits at around that 550, 570 mark. You can buy entry level assets in that market for around that early fives, but I prefer for our clients to be buying really good quality assets that, you know, they're either on a large block of land, you know, they're in really good condition, and they're easily rentable if possible. House versus unit prices, you can see there's a nice healthy gap there. So you look at the kind of median price at 465. If you're buying a slightly better quality suburb in Townsville, that's probably what we're recommending our clients do. And I think there's really good opportunities in that space, in that $500,000 range. Generally, rents are getting between $430 to kind of $500 a week per week for those assets. So really good quality entry points to consider. Again, stock on market, you know, there you can see when the market's starting to move, it was generally taking back in 2018, 65 days for an average house to sell. It's now taking less than 20 days for a house to sell. So there's only 281 dwellings on the market for sale. So there's not a lot of stock available. But, you know, we think it's probably a really good market to consider. Vacancy rate, again, that's attractive, sub kind of 2%. You know, we've seen probably rents increase in the unit sector and the housing sector. They've come off a little bit in the housing sector, but you can see rents are really attractive, you know, so you can probably buy something there that will generate a good rent. So your out-of-pocket expenses won't be too high to run that asset. Household lending, you know, there's a little bit of household lending. Owner-occupiers are out there in the market buying homes, and there's a bit of investor lending, but we really want to be seeing that trend upwards in terms of household lending. Job vacancies are good, so we're not seeing a sharp decline there. That's pretty healthy in terms of its long-term average, you can see. So plenty of available work if you're looking for employment or moving up there. And I probably want to touch on some of our pricing trends in terms of when we're looking at, you know, a falling market in terms of how we price these particular assets when we have our buying team on the ground. So you can see some of our long-term foundation assets are pretty attractive to be buying in right now. So if you look at those areas that are more kind of flat or within the range that we can actually buy, if it's being quoted within the particular range, we think we've got a good chance of picking up that asset. Melbourne's definitely in that flat range, and they're probably more of a foundation asset. So I think if you're looking to buy an asset and hold it long term, I think Melbourne, Bendigo, and Ballarat are all very attractive areas to be buying in and buying them quite well if you're taking a very long-term view. And you can see a lot of them are probably within that range. When we're looking at or analysing a market that's rising, we really want to be in, and those areas are such as Rockhampton, Brisbane, Adelaide, and Townsville. We kind of want to be buying in that top end of the range or within 5%. So you can see in terms of our pricing how aggressive or conservative we need to be when it comes to kind of buying in these particular areas. And where we need to be really aggressive in terms of being at the top end of the range between 5 and 15%. You can see those areas are Perth, both units and houses, Rockingham and Mandurah. These are the areas where we're getting, we're competing against multiple offers, not just one buyer, but multiple buyers that we're competing with. And we need to be really aggressive to try and secure that asset for a client if we can. Because we obviously have the data sets to see where that market's going. So we want to try and tie that asset in as quick as we possibly can at a reasonable level. But they're probably the kind of ranges that we probably are buying in. So that just kind of gives you a good overall view in terms of the markets that we're currently buying in. Now, in terms of our portfolio management, Paul and the team and our technology team have been working on this for a long period of time, and we've been talking about doing this for the last 5 or 6 years. And we've finally got it to a point where we've now developed a portfolio management app. Now, this gives our clients the ability to book in meetings. There's live data that goes into this. We think this is a fantastic kind of online client portal that you can jump on and have a look at your portfolio value, your net equity, your net yield, your loan to value ratio, your debt to income. It will give you an allocation across your primary residence, your residential investments, your direct commercial properties. And as we build out the syndicated and property funds, it'll actually give you an overall view in terms of your share and what you have in those funds as well. So you can really kind of see an overall picture of how your portfolio is going. You can also book in a call with your advisor as well. And then you can get you can access any of our research reports. The other thing that we want to implement was live investment opportunities. So when we see a particular opportunity and we don't have a client for, you have the ability to access live opportunities, whether it's residential, commercial, industrial. You probably have access to different types of investment opportunities that you may consider. Now, we've put pressure on the team. We've got version 1 of our client portfolio, which will be ready in July. So it'll be coming in the next, say, 40 days. We'll be sending out an email and an online link for you to kind of link up to that. Now, some of the future features that we're going to be adding on is obviously the advisor consult meeting notes, which I think is really important when you do the annual review. You can get an idea in terms of reviewing those notes. We'll have a portfolio modeling tool, which I think will be really important in terms of being able to model out your tool, working out where you are in terms of your portfolio and how far along the journey you are. Consolidated financial reporting and consolidated tax reports, because we all hate obviously putting all this information together and going to your accountant every year. So we really want to try and simplify that process for you if we can. So look, that'll be ready, and that's obviously some of the kind of future kind of planning that we're looking to put around that. So I think that'll be a really great value add for you to look at that, and then obviously build a stronger relationship with each of your advisors that's running your portfolio. So I think that summarizes everything. Hopefully that's been helpful, and I'll hand it back to you, Paul, in terms of any questions.
Thanks, Phil. No questions in the chat as yet. I'll give everyone maybe 30 seconds to a minute. If they've got any questions, feel free to pop them in the chat. We are recording today's presentation, so after the session over the next, say, 24 hours, we'll send out a video link so people can watch this. Well, if you don't have any direct questions for the session, we'll finish it up here. But please do get in contact with your advisor if you have any questions about the content from today. Obviously, there's a bit to take in, but I think some of the key messages is that we are really always trying to innovate in the research area. I think the new window, once we've fully developed that with the movement in different regions, will certainly help us predict when to buy and when to hold and when to sell out of regions. So that's a big one, and certainly keep on top of our research. We'll be communicating that in these presentations as time goes on. And obviously this information, you'll get access to live data and live research through the portal when that's up. So there'll be a few changes in terms of how we deliver our research over the coming months, but we'll keep everyone up to date. But thanks again to everyone who attended. Thanks to Phil for the presentation, and wish everyone a good Wednesday afternoon.